welcome to the Property Wealth Podcast. I'm so glad you're joining us today.
Yeah, thanks for being here. We've got a really interesting topic lined up for you.
Absolutely. We're diving into hard money loans today. What they are, when you might want to use them, and how they could fit into your real estate investing strategy.
Right, hard money loans can be a bit of a mystery for some folks, especially if you're new to investing or just starting to think about it.
Exactly. And we'll explore the pros and cons, plus some real-life examples of when they might be a good fit.
It's all about making informed decisions, you know? We want to help you understand how these loans can be a tool in your investment toolbox.
Yes, and we'll also discuss some alternatives to hard money loans so you can weigh your options and find what works best for you.
That's important because not every situation calls for a hard money loan, and understanding your choices is key to building that long-term wealth.
So whether you're just getting started or looking to expand your portfolio, this episode has something for you.
Let's jump right in then.
Sounds good. So first off, let's break down what hard money loans actually are.
So, Sarah, when we talk about hard money loans, it's not just about the money itself. It's really about the timing and the opportunities that come along with it, especially for folks over 40.
Absolutely. I think a lot of people see hard money loans as just a quick fix, but they can actually be a strategic tool, right? Especially with, the current economic climate.
Exactly. I mean, think about it. Many people over 40 are starting to think about their retirement timelines and how they can build a solid financial foundation for themselves and their families. Hard money loans can play a crucial role in that.
Right, and with inflation being a real concern, many are looking for ways to protect their wealth. Real estate tends to hold its value over time, but if you can leverage hard money to invest at the right moment, it can really amplify your returns.
Yeah, and I've seen this firsthand with some of my clients. There was one investor, let's call him Tom. He was in his early 50s and had been saving diligently for retirement. However, he realized that with the rising costs of living, his savings were not going to be enough to sustain his lifestyle. So he decided to invest in a property using a hard money loan.
That's interesting. What was his strategy?
Well, he found a distressed property in a neighborhood that was about to experience growth due to a new development project. He used the hard money loan to purchase it quickly. Cash offers tend to win in competitive markets, Then he renovated the property and flipped it within a year, making a significant profit.
Wow, that's impressive. So it's not just about the money. It's about having the right timing and seizing opportunities as they come, right?
Exactly. And for people over 40, it's also about wealth transfer to family. If you can create that equity now, it can be a legacy for your children or grandchildren.
That's a great point. I think many people might forget that aspect. It's not just about building wealth for yourself, but also setting up your family for the future.
Yes, and hard money loans can be a way to do that. They offer speed and flexibility, which is crucial when you're trying to capitalize on a good deal. In a market that's shifting, being able to act quickly can mean the difference between success and missing out.
I can see how that could be really valuable. And you mentioned emotional security earlier. I think that ties in here too. Knowing you have real estate assets can give a sense of stability, especially as you approach retirement.
Exactly. It's about peace of mind. Many of my clients feel more secure knowing they have tangible assets. It's one thing to have savings in a bank, but owning property can really change how you view your financial future.
For sure. And with the current economic trends, like rising interest rates, having a mix of financial strategies, like hard money loans, can create a buffer against those uncertainties.
And let's not forget the potential tax benefits that come with owning investment properties. For someone over 40, understanding how to maximize those benefits can really help in retirement planning.
That's huge. So if someone is considering this, what are some practical steps they can take?
Well, first they should really assess their financial situation and what their goals are. Understanding your risk tolerance is key. Then they can start networking, finding reliable hard money lenders who understand the market.
That makes sense. And maybe even connecting with other investors who can share their experiences?
Absolutely. Learning from others can provide invaluable insights. I've seen investors really thrive by forming partnerships. It allows them to pool resources and knowledge.
And what about the emotional side? I think that's often overlooked.
Right. Investing in real estate is as much about mindset as it is about the numbers. You need to be prepared for the ups and downs. Building a support system, whether it's friends, family, or fellow investors, can make a big difference in staying motivated.
That's a really good point. It can be daunting, especially if you're new to it. But knowing there's a community can help ease those fears.
Exactly. And remember, it's a journey. You don't have to rush. Take your time to learn and make informed decisions that align with your long-term goals.
That's really encouraging. I think a lot of listeners will appreciate that perspective. It's about building a life that feels secure and fulfilling.
Yes, and as we shift into talking about core strategies, let's keep in mind that these decisions can pave the way for a more comfortable retirement and a legacy for future generations.
I love that. So let's dive into those strategies next.
So Sarah, when we talk about hard money loans, it's really important to understand when and how to use them effectively, right?
Absolutely, Mike. I mean, they can be a great tool, but they really aren't for everyone. What's your first piece of advice for someone thinking about using a hard money loan?
Well, the first thing I'd say is to assess your project. Hard money loans are typically used for short-term financing, so they work best for fix and flip projects or when you need quick access to cash.
Right, like buying a property that needs a lot of renovations.
Exactly. You know, let's say you find a distressed property listed at, $150,000. You expect to put in about $50,000 for repairs. With a hard money loan, you could get that entire amount funded quickly, allowing you to close fast.
So it's about speed and flexibility, right?
Yes, and it's crucial to have a solid plan for how you'll repay that loan. Hard money loans typically have higher interest rates, often ranging from, say, 8% to 12% or more.
Wow, that's a big jump from traditional mortgages.
Sure is. That's why I always recommend using the 1% rule when evaluating properties for a hard money loan.
The 1% rule? Can you break that down for us?
Of course. The 1% rule suggests that the monthly rent you can charge should be at least 1% of the total purchase price of the property. So, in our earlier example, if you buy the property for $150,000, you'd want to aim for at least $1,500 in monthly rental income.
That makes sense. If you can't hit that mark, it might not be worth it.
Exactly. And then there's the 50% rule, which is another great guideline. This one helps you estimate your operating expenses.
Right. So if you're expecting $1,500 in rent, you'd budget about $750 for expenses?
Spot on. So if we take that $1,500 monthly rent, you'd expect around $750 for things like property management, maintenance, and vacancies.
That's a smart way to keep your finances in check.
Yeah, and speaking of checks, having a deal evaluation checklist can be a lifesaver. You want to make sure you're not missing any critical details.
What kind of things should be on that checklist?
Well, first off, the condition of the property. You need to assess what repairs are necessary. Then, you should evaluate the neighborhood. Look at recent sales, rental prices, and any up-and-coming developments.
And how about financing options?
Great question. Besides hard money loans, you might consider private lenders or even partnerships. Sometimes, pooling resources with other investors can lighten your financial load.
So if someone's hesitant about hard money due to the interest rates, they have alternatives?
Exactly, but it's all about weighing the pros and cons. For example, if you're confident in your ability to renovate quickly and sell or rent out the property, the higher cost may be justified.
And you mentioned earlier about having a plan to repay, right?
Yes, it's essential to have an exit strategy, whether it's selling the property after renovations or refinancing into a more traditional mortgage. You need to know how you're getting out of that hard money loan.
I love that you emphasize planning. It's so critical in real estate investing.
Definitely. And don't forget about the cap rate. Understanding the capitalization rate can help you evaluate a property's potential return on investment.
Can you explain cap rate a bit?
Sure. The cap rate is calculated by taking the property's net operating income and dividing it by the property's current market value. For instance, if your property has a net operating income of $10,000 and is valued at $100,000, your cap rate would be 10%.
So a higher cap rate generally means a better investment, right?
Yes, but it's also important to compare cap rates within the same market or property type. What's good in one area might not be in another.
That's a good point. It's not a one-size-fits-all approach.
Exactly, and always keep in mind the local market conditions. Is it a buyer's market or a seller's market? Understanding the dynamics can significantly impact your investments.
And that leads us to the types of properties you might want to consider for hard money loans.
Right, single-family homes, multifamily units, and even commercial properties can all be viable options, depending on your strategy.
But those come with different challenges, don't they?
Absolutely. Single-family homes might be easier for first-time investors, but multifamily units can offer better cash flow. It's all about what fits your goals.
So what's the key takeaway here?
Know your numbers, have a plan, and always do your due diligence. Hard money loans can be a powerful tool if used wisely, but they come with risks, just like any investment.
And those risks can lead us into our next topic. Common pitfalls to avoid when using hard money loans.
Yeah, that's a critical conversation because understanding potential missteps can save you a lot of headaches down the road. You know, Sarah, one of the biggest pitfalls I see with hard money loans is over-leveraging. It's like investors get so excited about a property, especially when they think they have a great deal, that they stretch themselves too thin with the financing.
Yeah, I can totally see how that happens. It's easy to get caught up in the moment and forget about the long-term implications, right?
Exactly. I mean, I had a client once who jumped into a renovation project thinking the after-repair value would be way higher than it actually was. They borrowed way over what they needed, and, well, when it came time to sell, the market had shifted.
Oh no. So what happened?
They ended up selling at a loss. The renovations cost more than expected, and the market just didn't support their projections. You know, they were left holding the bag with a loan they couldn't really manage.
That's tough. So what can someone do to avoid that?
Well, first, it's crucial to have a solid understanding of your local market. Do your homework, look at comparable properties, and maybe even talk to a local real estate agent. Also, it helps to leave some cushion in your budget for unexpected costs.
That makes sense. And how about bad tenants? I've heard horror stories about that.
Oh, absolutely. Bad tenants can absolutely derail your investment. I had another client who used a hard money loan to buy a rental property. Great location, or so they thought.
But?
They didn't screen tenants properly and ended up with a tenant who just didn't pay rent on time, or at all, really. They spent so much time and money trying to evict this person that they missed out on potential income for months.
That's really frustrating. How can investors protect themselves from that?
It really comes down to rigorous tenant screening. Check references thoroughly, run background checks, and maybe even meet prospective tenants in person. You want to ensure they're reliable before you hand over the keys.
Right. And what about cash flow? I guess that's another area where investors can get tripped up.
Definitely. Ignoring cash flow is a common mistake. I remember working with an investor who bought a property with a hard money loan, thinking they'd quickly flip it. They didn't account for the holding costs, utilities, property taxes, you name it.
So they underestimated their expenses?
Exactly. They thought they could just renovate and sell within a few months, but the project dragged on longer than expected. They were paying out of pocket for those holding costs, and it really ate into their profits.
Oof, that sounds painful. So, what do you recommend for keeping on top of cash flow?
Keep a detailed budget and factor in all potential costs, not just the mortgage payments. It's also a good idea to have a contingency fund. You never know what might come up, and having a financial cushion can really save you.
That's smart. Now, I've also heard about people trying to time the market. Is that another pitfall?
Yeah, absolutely. Trying to predict market trends can be a slippery slope. I had a colleague who thought they could buy low and sell high by waiting for the perfect moment.
And how did that go?
Well, they waited too long, and the market actually took a downturn. They ended up holding onto a property that lost value instead of gaining it. It's really easy to get caught up in the idea of timing the market, but it's almost impossible to do consistently.
So what's the advice there?
Focus on the fundamentals. Invest in properties that have good cash flow potential, and don't let market trends dictate your decisions. A solid investment strategy should be more about long-term value than trying to catch the next wave.
That's a great point. And what about hidden costs? I imagine those can sneak up on investors too.
Oh, for sure. Hidden costs are like landmines for new investors. I once worked with someone who bought a fixer-upper, thinking they'd get a great deal with their hard money loan. They didn't budget for things like permits, inspections, and unexpected repairs.
Yikes! So they ended up spending way more than they planned, huh?
Exactly. And the kicker was, they didn't account for the time it took to get everything done. All those delays meant they were paying interest on their loan longer than anticipated, which really cut into their profit margin.
That sounds like a nightmare. So how can investors spot those hidden costs early?
Do thorough due diligence. Get a good inspection report and consult with contractors before you commit to a project. Also, make sure to factor in all potential costs and maybe even add a buffer for unexpected expenses.
Such solid advice, Mike. It really seems like a lot of these pitfalls come down to preparation and research.
Absolutely. Knowledge is power in real estate investing. If you can spot red flags early, you can avoid a lot of headaches down the road.
And if someone finds themselves in a tough spot, what can they do to recover or avoid these traps in the future?
The first step is to reassess the situation. Look at what went wrong and learn from it. Maybe even consult with a mentor or a real estate advisor to get a fresh perspective.
That's a great idea. And it's important to remember that setbacks can be learning opportunities, right?
Exactly. Every mistake is a chance to grow and refine your strategy. The key is to stay adaptable and keep learning.
Well, there's definitely a lot to consider when it comes to hard money loans and real estate investing. Thanks for sharing these insights, Mike. I think our listeners will find them incredibly valuable.
My pleasure, Sarah. I'm always here to help them navigate the complexities of real estate investing. All right, so now that we've laid the groundwork on hard money loans, let's dive into some real actionable steps that folks can take right away.
Yeah, I think that's super important. Just knowing where to start can feel overwhelming, right?
Exactly. So the first thing I'd recommend is to simply start analyzing deals. You could set a goal to analyze, say, one deal per week. It doesn't have to be anything fancy. Just pick a property that catches your eye and break it down.
That's a great approach. It's like practice, but with real-world applications.
Right. And to help you with that analysis, there are some fantastic tools out there. For instance, the BiggerPockets calculator is a really solid option. You can input your numbers, and it helps you crunch the data, cash flow, ROI, that sort of thing.
Oh, I love that tool. And what about Zillow?
Absolutely. Zillow is invaluable for getting a sense of property values and trends in different neighborhoods. Plus, it gives you a good overview of what's on the market right now.
And if you're looking to analyze rental properties specifically, Rentometer is another tool that can give you local rental rate comparisons.
Yes, Rentometer is great for understanding if the rent you're considering will actually cover your costs. And if you really want to dig deeper into specific investment properties, having local MLS access can be a game changer.
Oh, for sure. That gives you a lot more detailed data than what you'd find on sites like Zillow.
Exactly. And don't forget about DealCheck. It's another useful app for analyzing properties. You can create pro forma reports and see if the numbers make sense.
So it sounds like having a mix of tools is really beneficial.
Definitely. And along with that, I think it's helpful to set up a habit of connecting with others. Joining local meetups or real estate investment groups can provide insights and support.
Networking can really open doors. Plus, you can learn from others' experiences, which is invaluable.
For sure. And it's also a good idea to read some books or listen to podcasts that focus on real estate investing. It keeps you motivated and informed.
Any favorites you'd recommend?
Well, the book on rental property investing by Brandon Turner is a classic. It covers a lot of ground and is really accessible. And for podcasts, BiggerPockets podcast is excellent too. Lots of real stories and practical advice.
Those are solid picks. It's like getting a mini mentorship through your headphones.
Exactly. And speaking of starting small, even if you can only dedicate an hour a week to this, that's a step forward.
Right. It's all about being consistent, isn't it?
Yes, and don't underestimate the power of just jotting down your thoughts on deals you analyze. Start a simple spreadsheet or a notebook. Track what you learn and how your understanding evolves.
That's a fantastic idea, Mike. It's a way to reflect on your progress, which is super motivating.
And as you get more comfortable, you can start looking for potential funding sources. Maybe reach out to local hard money lenders and see what their criteria are.
Great point. Just getting familiar with the lenders and their processes can really demystify the whole thing.
Exactly. And remember, you don't have to dive into the deep end right away. Start where you are, take small steps, and build from there.
That's such an encouraging mindset. It makes the whole process feel a lot more manageable.
Absolutely. And those small steps can lead to big opportunities down the line.
So those are some practical first steps. Now, let's bring this all together.
So as we wrap up, let's quickly highlight some key takeaways from our discussion on hard money loans.
Absolutely, Mike. One big takeaway is that hard money loans can be a fantastic option for those looking to move quickly on a property, right?
Yes, exactly. They're great for investors who need fast funding, especially in competitive markets. And remember, they're typically backed by the property itself, rather than your credit score.
Right, and that leads us to the second point. Due diligence is crucial. You've got to really know the property's potential value and the costs involved.
Definitely. It's not just about getting the money. It's about ensuring that your investment will pay off in the long run.
And then there's the importance of having a solid exit strategy.
Exactly. Whether it's refinancing, selling, or holding for rental income, knowing how you'll exit is key for your success.
So true. And let's not forget that hard money loans can be a stepping stone to bigger investments if used wisely.
Yes, they can really open doors to opportunities that might otherwise be out of reach.
You know, this whole process of investing in real estate can seem daunting, especially if you're over 40 and just starting out. But it's all about taking that first step and learning as you go.
Absolutely. Building wealth is a journey, and real estate can be a powerful part of that journey.
So, if you found value in today's episode, we'd love if you could like and subscribe and share your biggest takeaway or any questions in the comments. And don't forget to tell someone over 40 who's interested in investing in property.
And next time, we'll dive into private money, raising cash from friends and family. That's a really exciting topic.
It sure is. Until then, keep exploring those opportunities, and we'll catch you next time.
Take care, everyone.
Bye for now.